Hello again from me, Kevin French at Core Wealth. We are recording this after the Easter weekend, so for those of you who celebrate Easter, I hope you had a wonderful time. We are going to be looking at the month of March 2026, which was quite a tumultuous month, lots happening around the world, and we'll go and see how that has impacted the world, the markets, and your portfolios. So the big news in the month of March was all of the escalating tensions in the Middle East. We saw Israel and the United States escalating their attacks on Iran, and we saw Iran increasing their responses and attacks on their neighbors during the month of March. This sent the oil price skyrocketing from $70 a barrel to up to $120 at one stage. At the moment, as we're recording, it's just over $110 a barrel, but that's a significant increase in oil, which affects countries around the world. The other area, and we'll talk about this a little bit later, is the impact of the blockage in the Strait of Hormuz, which is a key feeder of oil exports from the Middle East to the rest of the world, particularly to the east. Now, the knock-on effect of the higher oil price is inflationary for the world. In other words, inflation will go up because of the impact of oil on many, many things. Transport, obviously, a large one. On the back of this, we have seen markets react quite nervously, and we've seen stock markets come down strongly during the month, which I'll show you in a few slides' time. So this has had a knock-on effect onto the bond markets, which you'll see has fallen quite sharply. We've seen the global mega caps in the US, some of the big tech names, falling to their cheapest level relative to the rest of the market since the global financial crisis in 2009. Closer to home for our South African clients, we've seen that the South African stock market was also down quite sharply, just over 10% for the month, and this was in unison with the rest of emerging markets around the world. The big question around all these areas is how much of this is turning into a structural problem, in other words, a long-term impact, and how much of it is just a cyclical reaction to what's happening with this war. In South Africa, we still have a number of improvements that should help keep this structural, things like the budget that we spoke about recently, the fact that we're targeting inflation at a lower level for the longer term. These are all good things that still hold South Africa in good stead longer term. So let's have a look at how actual markets reacted, and we can see on this slide a lot of red for the month of March. The developed world equity markets actually on a relative basis only 6.4% down, and leaving it over the year to date down 3.6%. We can see one of the worst places to have been was the Japanese equity markets, and that's because Japan gets most of its oil from the Middle Eastern area and the risks of inflation having a knock-on effect there. Europe also hit quite hard during the month, and then global bonds down some 9.3%, but that still is showing a positive year to date. So you'll see when we talk about our portfolios later that although March has been a quite tough month, in many instances we have just lost what was gained in January and February. Over the 1 year and over the 3 year, you can see some still very, very healthy returns over both of those periods by virtually all of those markets. So if we have a look at the South African financial markets for the month of March, we can see the equity market down just over 10%, just slightly negative year to date. So again, March just took away what had happened in January and February. Listed property down the worst for the month. Our bond market also down in unison with the rest of the world. If we have a look at the currencies, we can see that the dollar strengthened by some 7.5%, the pound by 5.5%, and the euro by 4.9% against the rand. But if we have a look over the last year, the rand is still stronger against all of those currencies than it was a year ago. And again, similar to the global markets, the 1, 3, and 5 year periods of the South African markets all looking very strong, despite this sharp pullback just for the month of March. So the model we're going to focus a little bit on during this month in the Core Wealth portfolio is our Core Wealth RI growth model, RI standing for recurring income, and it's a model that's specifically used for clients who are drawing an income from their investments, typically the retired clients and those who have living annuities, for example. Here we can see on this slide our RI growth strategy. It's been running since October 2013, so almost a 13-year track record now. It's targeting inflation plus 5. It doesn't have to be Regulation 28 compliant, because Regulation 28 falls away once you retire from your retirement annuity or pension fund. 55 and 75% of its investments will be in growth assets. And then on the graph on the right, we just show how it's performed since its inception. The purple line is the core wealth strategy. The gray line is the peer group, so the rest of the class, as it were. The green line would be if you'd just invested in cash, and the red line is just to keep up with inflation. And we can see that the fund has actually outperformed quite nicely against its peers over time, and well ahead of inflation and cash as well. If we have a look inside, one of the managers that we use inside this fund is the PSG Flexible Fund. That has also been going for a number of years, and you can see here it's a sizable fund, over 20 billion in that PSG fund, and it's a manager we've used because we've seen their ability to move between good companies, listed shares, and things like cash, and move between them as markets change, and also pick some very good shares. And we can see there some of their top 3 holdings include Discovery and Glencore, which have done very, very well over the last year. They also have a holding in Anheuser-Busch, which hasn't done as well over the last year. All in all, they're a manager who's generated some good outperformance over time. Lastly, if we just have a look at where this fund is invested, which asset classes, that's what's on this slide. And you can see on the left, some 31% in South African equities, and just follow your eye through. The purple bars are the core wealth strategies weightings, and the grey bars are the peer groups. We've got slightly more growth assets at the moment compared to the peer groups. That's the bars on the right hand side. Slightly less foreign exposure, but both of us getting close to 30%. But over time, this has generated outperformance while reducing the volatility, in other words, how up and down things are, because investors are drawing income on a regular basis. I don't want to spend a lot of time on the model's relative performance, but suffice to say, we'll look at the different colors. If it's green, we're outperforming the peer groups. If red, we're underperforming. These are our US dollar global strategies. And you can see, even after the month of March, where we had that sharp pullback globally, our global strategies in US dollars have still outperformed their peers quite strongly. Look at the relative column, and the absolute return in our global growth strategy, for example, 18.4% up for the year. Similarly, on the UK or the British sterling strategies, you can see the same thing in this slide. And then if we go lastly to our South African models, again, the 1-year numbers, strong outperformance. Our defensive strategy slightly behind its peer groups, but just by 0.2%, but some real strong performance over the longer term, just showing that March was not an all fall down period where we lost years worth of returns. It's basically we're back to where we were at the end of December. So we're going to have a look at what oil price shocks do to global markets in the next few slides. I'm sure you've heard of Operation Epic Fury, which is the name that Donald Trump has given to this action that they're taking in the Middle East. And this slide just shows you the impact that that's had. The slide on the left just shows you the oil price, and you can see over the last month how sharply that blue line has shot up in that time, going from around $77 a barrel pre the war, getting close to $120 at one stage. And then the graph on the right just shows how volatile the oil price has been. And this is just looking from the beginning of this year, but you can see it was relatively flat and not that volatile for the first almost 2 months of the year. And then on the 28th of February, when the attack started, you can see how that volatility has shot up. It has come back a little bit towards the end of March, as there were some comments and expectations that there could be a political agreement reached as to how the Middle East process would continue. The Strait of Hormuz is one of the key areas in terms of global oil movement. It's an area about 33 kilometers wide, just south of Iran and just north of Oman and the UAE. With 20% of all oil flow around the world going through there, with it being closed at the moment, it's created a lot of tension and turmoil for the oil price, and that is really what has driven the oil price upwards. Now, I mentioned at the beginning of this video that inflation is the key thing that the world is worried about. And what we show you in this graph is just how obvious that is. The gray shaded bars just show when there's an oil shock. The orangey color shaded bar shows you that when there is a US recession, in other words, their economy slows down. Importantly, the light blue line shows you the change in oil price. So when it skyrockets as it did in 2022, that means its price has gone up dramatically. But then importantly, what happens to the dark blue line is US inflation. You can just see it with your eye. There's a very high correlation between when the oil price, the light blue line, goes up sharply, then US inflation typically follows on after that. And that is the concern around the world. If inflation goes up, if interest rates are going to go up, chances are the economic growth will slow down, and that's not really what the world wants. The key difference at this point in time is that inflation is already at a relatively lower level. It was quite high in 2022, and also that interest rates are more restrictive at the moment, whereas they weren't back then. So there was room, and what happened was a very, very fast and high increase in interest rates happened in 2022, which we don't expect to happen this time. Let's just have a look at possible vulnerabilities for South Africa. Now, this is a very busy slide, but if you look down the table on the left and you go to the third from the bottom is South Africa. And we can see that our net score, your net score, the lower the score, the better. We're kind of in the middle of all emerging markets. But two key things that are very important that will, I think, make intuitive sense. One is that in terms of our oil reserves, we actually have about 22 days of oil reserves, which relative to the rest of the world is actually quite reasonable and probably slightly above average if you look at those numbers, other than oil exporting countries, which are the final lot on the right-hand side. The other areas where we are also very well situated is that our foreign exchange reserves are actually very high compared to the rest of the world. And that means we can control if there are concerns around currencies and that people won't just naturally go and try and game our currency for their advantage. So in short, if we have a look at this, South Africa is positioned kind of in the middle of the pack, but has some good attributes that will enable it to ride through a storm like this better than most other emerging markets. And lastly, let's have a look at how global markets have repriced. On the left-hand side, we've got bond markets. So bond markets, the higher the yield goes, the more expensive the bond is, and we've seen a sharp uptick in the month of March, and that just means bonds are more attractive now to buy for the longer term. On the right hand side, we're showing the forward price earnings ratios for different global equity markets, and interesting point is that at the moment the forward price earnings ratio has dropped in the US on the S&P from 23.8 to below 20. This is the first time in quite a while. And so again, a number of those big tech companies in particular are looking a lot cheaper. And then interestingly enough, one would have expected the gold price to continue to go up in this time of turmoil, but it's actually dropped by about 15%. What a number of countries have done who had been building up their gold reserves, as we'd mentioned in previous videos like this, they've started to sell some of those in order to back their defense spending or just to defend their currencies. I know we went into quite a bit of detail around the oil impact, but I think it hopefully was helpful for everyone. If you have any questions, please get hold of us, give your advisor a call. We'd love to engage you around that. If there's any specific topics you'd like us to cover, please send us a comment and we'd love to address those in the future.